Okay, thank you for joining me, everyone, today. I hope you're well and thriving, whether you're in Australia, in America, or in Europe. I'm going to give you the senior market perspective trader's view of the market, and that means looking at the big plays for 2023. And we're all close to big reversals. So let's crack on with the show. I want you to take out a pen and paper because I'm in the business of bringing you on the path to early retirement. So why listen to me? I've got 40 years experience in the markets, and that includes 13 years at the Mad Hedge Fund Trader. I have a Master's of Business Administration. I've spent 10 years running a self-managed super fund, 30 years experience teaching English to foreigners, which means I'm very patient and can impart knowledge really well. I've spent 1 year as a jillaroo or ranch hand in outback Australia, which means I'm very versatile and practical, and 1 year baking treats for a coffee shop in Kent in the UK, which means if we get together to chat about the markets and trading, I can bake you a really wickedly good cake. Okay, and we've gone ahead too much. Oops, where are we? Okay, sorry about that. So if you want to change your life, what happens when you do that? You get to travel all over the world, as I have done. So here on my left, I'm in Switzerland hiking, while my son was at a French language camp nearby. I also took him to the Solomon Islands to show him how the other half live, and that showed him what people do when they don't have a loo. On the right, I'm at a lovely restaurant by the Thames, enjoying a beautiful meal and keeping an eye on my trades. So a little bit more about me. I grew up in Toowoomba, Queensland, Australia. Toowoomba's the largest inland city, about 2 hours drive from the golden beaches of the state. It's got country charm, as known as the Garden City, with many parks and gardens and an annual Carnival of Flowers spring event. Down the bottom is the house that I grew up in. And on the left side are two of my special animals that I had growing up, Lucy and Pepper. My childhood was about being active. I was on a swimming team and tennis team, and I also did ballet. I did a secretarial course after leaving school and then was sent to the outback as a jillaroo, as a ranch hand. My mother was always very keen to push me out of my comfort zone. So this is what it looked like when I went to the outback. I learnt to ride horses, I busted cattle, did fencing, and I also assisted the cook feeding the jackaroos. And I also helped 2 children with their schoolwork. Windora was a 1 shop, 1 pub, 2 tennis court town. I came back to the city and got a job at the Toowoomba Hospital as an administration officer in the psychiatric and alcohol and drug unit. And what I saw there was enough to turn me off alcohol for good. I studied for 10 years while working and finished off with an MBA. My mother introduced me to the stock market when I was in my teens. Her rule was very simple: buy shares and never sell them. Never, ever sell your capital. Only use what that capital makes. So that's what I did. I started buying shares in my early 20s. I held my stocks through every market downturn we have had. At market bottoms, I just bought more. As I said, I joined Mad Hedge Fund Trader in 2010 and have spent 13 years there making money through this great trading system. So I now spend my days trading, finding trades on the beach, in the garden, traveling, or enjoying time with my son, Alex. I love helping people gain new skills, and there is far more satisfaction taking people from a $5,000 account to $50,000 than anything else that you could do. So this is my son on the right at 8 years of age on his first day at Ludgrove. And this is the school, Ludgrove, in the wintertime, a beautiful school. And these are the fees I paid over 5 years, 9,000 plus a term, and there were 3 terms in the year. So that's £9,000 every term. So the method to my madness. Risk markets will be trapped in a range for months until the economic data breaks out. Aggressive growth tech and small caps will lead the next bull market. A house intent on debt default still caps bonds, sending yields back to 4%. Bonds will be the top performing asset of the year thanks to soon falling interest rates. Gold and silver and commodities take a hit on higher interest rates, but this is temporary. Energy is going to new lows on Russian military failures, warm weather, and a supply glut. The US dollar has had a bounce as interest rates stay higher for longer. The VIX dives to 20. There is no trade here, and cash is king. This is the trade alert performance of the Mad Hedge Fund Trader. The 22 out of 23 alerts have been possible. In March to date, we are up 2.86%. Our average annualized return is 47.22% for over the last 15 years. The economy is confused. The Fed minutes show more hikes to come, and that could take the overnight borrowing rate to 6%. Nothing happens, though, until March 14, when the next big inflation read, the core CPI, comes out. Q4 GDP dips from 3.9% to 2.7% in the October-December quarter. Consumption took a dive, which is amazing over the holidays. You'd think people would be spending. Consumer price pops 0.7% in January. It's hotter than expected. China manufacturing PMI hits 11-year high at 52.6. And China sets hot 5% growth target for 2023 as zero COVID ends and herd immunity takes over. Okay, as well as looking for stocks, I'm always on the lookout for a quaint sewing shop. And on the left, I found this fabulous sewing shop in Whitstable in Kent. And on the right, I found a beautiful sewing shop in Canterbury in the UK and a wonderful tea room in Canterbury also. So the stocks, the bull case, what is in the market now? High inflation, oil shock, spike labor shortage, supply chain headaches, interest rate rises, quantitative tightening, and poor earnings. So what will the market discount next? Plunging gas prices, plunging commodity prices, stabilizing supply chain, record 3.5% unemployment, better than expected earnings, 1.25 trillion in stock buybacks, soon to fall interest rates, and a weak dollar. So remember, when you are trading stocks, you are all in the what's going to happen next business. Okay, oops. Oops, sorry. So we're looking for a year-end target on the S&P at 480 or up another 20 from here. We run a barbell portfolio, which is 50% big tech right now. 2% of the US workforce is accounting for 27% of the market cap, an incredible 38% of all profits. The other 50% goes to domestic recovery stocks, including airlines, cruise lines, couriers, steel companies, banks, commodities, construction, credit card companies, hotels, casinos, and online ticket sales. Boeing has been one of our favorite stocks for a while. We got the bottom here back in October. Since then, the stock has doubled or more. Actually, we're up about 120%, and we expect a long sideways move, maybe a pullback to 190 or so. Eventually, we see the stock hitting 450. The 737 MAX is flying again. In fact, I flew it from Hawaii a couple of weeks ago. The US airlines are now suffering from a major aircraft shortage, and Air India just placed an order for 450 planes, the largest such order in history. We love the banks. It's the quality value play. Banks love rising interest rates and falling default rates. They're hugely overcapitalized now, moving into online banking and closing their expensive branch networks to cut costs. If you walk into a branch now, they say, "Do you have our app?" and you can do all these transactions on it. So basically, they don't want you in their physical buildings, but they do want your money. Anyway, JP Morgan has had a tremendous run, up 45 since October. We expect more sideways movement and then a breakout to the upside. We're looking for 200 for JPM. Visa, another big winner of inflation, catching exploding online commerce, COVID-19 recovery. 15 of all credit card charges are for travel charges. Like last summer, this coming summer, we'll see one of the epic travel booms of all time. And don't we all do it? We all put our travel on credit cards. We're looking for all those points, aren't we? All of that goes onto credit cards. We've had a big move since October from 175 to 235, and we're looking for 300 by the end of this year. Union Pacific is the preeminent east-west route in the US, and that means we import a lot of stuff from China, ship them a lot of commodities back. Both ends of the transaction are recovering. It's a great stock to play. Looks like we're going to get a double bottom here around 185. After that, we expect a move in UNP to 300 a share. Federal Express now not only moves big stuff, but also small stuff. There's been a massive increase in overnight deliveries. And that also, they got a lot of vaccine business during the pandemic. And again, we've had about an $80 move since the October bottom, or about 50%. We're looking for 300 by the end of the year. Berkshire Hathaway is the one-stop barbell portfolio. It has heavy weightings in the banks and also in industrials, and they're the largest outside owner of Apple. We've had a nice $60 move, or 25%, off the October bottom, and notice that all of these stocks are massively outperforming the main indexes and will continue to do so. Berkshire is a massive buyer of its own stock whenever it trades at a discount, like it is now, so we're targeting 400 a share in Berkshire. The second half of the barbell bets on a massive drop in interest rates and global recovery to begin by the end of 2023. The upside potential for recovery stocks is far greater than tech. Some of these stocks have not moved for 5 or even 10 years. Focus on economically sensitive cyclical industries. It makes a great counterweight to high growth technology and other stocks, and we could spend years rotating between the two groups. So here's the main index, the NASDAQ. It's just had a heroic run to the upside, some 25%, and we're looking to give up at least half of that since this is the most volatile sector in the market. And then you want to be a buyer. We're looking for 18,000 in NASDAQ by the end of the year, or a gain of about 40% off the lows. Microsoft is a big leader here. Accelerating economy means more PCs and operating systems. They're also moving big time into the cloud, with their Azure service moving to subscription services. Notice that your Microsoft bill keeps going up every year, a bit like everything else. The pandemic drove a huge rise in PC sales and gaming. It's good for my son. I'm looking for 350 by the end of this year. Apple 5G is here. 1 billion phones need to be replaced to move into a 5G, and you can expect Apple as a major buyer of their own stock. We're targeting 200 for Apple by the end of this year. A few weeks ago, they announced new breakthrough technology. iPhones can now monitor your glucose level if you have diabetes, which is about 11% of the US population, I believe. And that's just the beginning of a major move by Apple and the other big techs into healthcare. Amazon has their global online sales presence. We're looking to buy on the dip here. We're looking for 150 in Amazon. And again, all of these big techs are major players in artificial intelligence, which has become the theme of the year. It seems, by the way, likely the government will file an antitrust suit against Amazon. If they end up breaking up the company, the value of the individual pieces is worth double what Amazon is itself worth now. So we certainly saw that with the breakup of other monopolies. Google has a near monopoly with 92% of all searches, and 15% of all searches are for travel. And I'm one of those who use Google for travel searches. If we get a double or triple bottom here in Google, I'd be a major buyer. We're looking for 150 a share by the end of the year. Salesforce speaking customer relation management on the cloud. The sector that's growing exponentially just announced major staff cuts and cost cutting. We want to buy this one on the dip also after its $50 gain from October. We will be watching all those that had the biggest move since October because they will have the biggest gains when the next leg of the bull market returns again. We're looking for $2.50 a share in CRM. Tesla. We love Tesla here at Mad Hedge. If you include the federal subsidies, Tesla now holds the #1 and the #2 spots in the California car market. After about a $50 pullback, we're looking to buy Tesla again. We bought it down here at the 105, 110 level, and our target for the year is $300 a share. The Elon Musk target for the stock is $1,000 a share, and so far he's been pretty right. Okay, I can find. Okay, bonds is another major asset class we play. We're probably the only online service that makes bond recommendations, and as a result, we have that market to ourselves, and we make a ton of money on bond trades. The Treasury Secretary's warning of a coming US bond default, saying the government runs out of money by June, is caps bond prices for the foreseeable future. Stock guru Jeffrey Lockhart says you want to be overweight bonds with 60% of your portfolio against 40% in stocks. So bonds are entering buy territory at the bottom of the range, driven by debt default warning. 10-year US Treasury yields jumped from 3.3% to 4.5%, still looking like a 2.5% yield by the end of 2023. TLT should reach 120 in 2023 without any political interference. That'll probably happen after the summer. So our suggestion is to keep buying TLT calls, call spreads, and leaps on dips. Junk bond ETFs will also do well. You want to look at the ticker symbols JNK and HYG. They are great high yield plays. And here is the TLT chart. First of all, it was the short of the century, and now it is the long of the century, targeting 120. The 10-year Treasury yield has run from 3.30 to 4%. We expect a peak around here, and the next target by the end of the year is 250 on the 10-year Treasury. That equates to a move of about 20% in the TLT. Onto foreign currencies. We have higher rates for longer, and the prospect of a 0.5% rate rise giving new life for the dollar. You want to be fading the dollar at every opportunity. The dollar sell-off may resume after March 22 Fed meeting. Any strength to the dollar will be temporary. So we're looking for dollar lows by the end of 2023. We think you should buy FXE, FXY, and FXB on dips. Okay, next. Oops. And here is the Australian dollar. We see a move from 65 going up to 1-to-1 against the US. The Aussie economy, with their major commodity exports and food exports, is essentially a call option on the recovery of a global economy. And the best way to play that is by buying FXA. Oops. I go one ahead, sorry. Oops. Oops. I need to go back. Sorry, jumping ahead. The euro, we're looking for 25% gain, even though World War III is on their doorstep. And the British pound is looking to be up 15%, even though it's lost 10% of its performance to Brexit, which will be a drag on the economy for the next few decades. By the way, this is the new British pound with King Charles III on the coin. Emerging market currencies will be huge performers as well, up 40%. And the way to play that is with CEW, the ETF CEW. Energy and commodities, a great trade is here. But long term, this stuff goes to zero, even though it may take 30 years to get there. And on the way to zero, you'll have several doubles and triples. So it is a trading instrument, not an investment. So last year, oil companies reaped a stunning 128 billion in profits, which was brought on by the Ukraine war, which took Texas tea prices to $132 a barrel. That's what you do when you know your industry is going to disappear in a decade. But if there's no US recession and China's reopening accelerates, we may have to visit $100 a barrel. We want you to buy, and we're going to buy, UNG on dips, which is going to be up 40% in 2 weeks. Germany accelerates its move towards alternative energies and hopes to get 80% of its electricity from solar and wind by 2030. The Chinese economy is recovering and is providing some support for oil prices on the back of herd immunity. Russian oil hits a 2-year low when priced in rubles, setting off a budget crisis and 500,000 barrel a day production cuts. Caps on oil purchases from Russia is succeeding. US is now the world's top oil producer. That puts the US in the driver's seat, but we're looking for lower lows, probably down to $50 a barrel. Oil's been in a downtrend for 20 years. The return on oil stocks on a 20-year view is effectively zero. You can see here is a double top, which we should be going back down to the pandemic lows of $10 a barrel. Here's your nat gas chart. We've moved to nat gas exports from China to Europe. That headed off the energy crisis in Europe and kept the Europeans warm and the Russians at bay. That said, we're now at the pandemic low right here, so I'd be buying nat gas on dips, targeting a double from here at least. And also the Chinese recovery is bringing support to nat gas. Precious metals, we're going bottom fishing here as well. Gold may have found a bottom here, prompting another round of buying. Silver is beating gold as massive new industrial demand kicks in from several sources, including solar and EVs, and is also a China recovery play. Silver is now an industrial commodity, while gold is still a precious metal used for jewelry, investment, and central bank reserves. A massive silver shortage is developing, with demand of 1.2 million ounces, with EV production increasing from 1.5 million panels to 20 million panels a year within the decade. EV makers will be running up against supply shortages. To meet ambitious production forecasts, metals production must triple quickly. So there will be big moves in copper, aluminium, silver, chromium, and lithium. With interest rates certain to plummet later in 2023 as the Fed reacts to a recession, precious metals could be one of the big trades for next year. Gold will also be a big performer in 2023. Collapsing interest rates, as I said, will be the big story here. We're down to $1,841 an ounce, which is down about 7% from the recent high. We're looking for $2,200 to $2,300 an ounce by the end of this year. And of course, we've been buying the dips and putting out leaps since October. If you like gold, you'll want to buy the world's largest gold miner, which is Barrick Gold. We see Barrick moving from $16 to $50 by the end of 2023. That's a 230% gain. Silver is another big play. It has roughly 2 times the volatility of gold. We're targeting a move from $17 up to $50 an ounce by the end of the year. So don't play with matches. You could probably do okay just buying all the stocks I mentioned and forget about them. However, the reality is the conditions for these companies change every day. They're all viciously competing, trying to put each other out of business. If you don't get daily updates on the fundamentals, you could easily get wiped out. Today's big winners could instantly become tomorrow's losers. That's why you need somebody like the mad hedge fund trader to guide you through this minefield. I gained financial independence, and so can you. You can go from a complete beginner to a pro in weeks. You can quit your day job, supplement your income, trade full-time from anywhere in the world. The real truth is most individual traders lose money. They lack the correct training and discipline to succeed. The broker's job is to make money for himself, not to make money for you. Wall Street is all about moving money from the uneducated to the educated. The easy solution is to get educated. Fidelity did a 20-year study, and they found the top performing investors were dead people. And why is that? Because they never sell. What you need is a real pro to guide you through this jungle. 95% of it can be completely ignored. You just need to know which 95%. There are a few great sectors and a lot of awful ones. You can earn a 10x return on the great ones, but get wiped out on the losers. So let us guide you through the maze. This is our secret weapon, the Mad Hedge Profit Predictor, a market timing index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators, and took a team of mathematicians 1,000 hours of calculations to create. So anything approaching 80 is a strong sell, and anything approaching 20 is a strong buy. The next move is likely to be back down to the 20s. So why do you need an algorithm? Algorithms have become a dominant fixture in the market. You should never trade without one. It does the work of a 100-man research team department in seconds, runs real time and optimizes returns with the addition of every new data point far faster than a human can imagine. Algorithms provide you with a defined systematic trading discipline that will enhance your profits. And I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. Here's 3 years of profit predictor performance. Lots of buys at market bottoms and lots of sells at market tops. It becomes a money-making machine. And this is where most traders make their errors. It's the psychology that gets in the way. They sell at market bottoms and they buy at market tops. So we're in the business of showing you how to do the opposite. This is our average annualized return for the last 15 years, 46.84%, and that is 2.66 times the S&P 500. Richard, one of our clients, made millions religiously following the Mad Hedge Fund Trader alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast. Greg, another client, turned 100,000 into 1.5 million solely on Mad Hedge Fund Trader trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, Tesla Powerballs, and a Tesla Model 3. He'd be a great ad for Tesla, wouldn't he? And still had enough money left over to send his kids to college. So what do we do about all this? Stocks, we want to buy the next dip. Bonds, we want to buy dips. Commodities, we want to buy dips. Energy, we want to stand aside. It's going to zero. Currencies, we want to buy foreign currency dips. And precious metals, we want to buy dips. If you are not up 85.11% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. And that's my son, Alex, in a play at Ludgrove, probably wondering what he has to do next. Our trailing one-year return is 85.51% versus minus 10.18% for the S&P 500. And this is a beautiful scene of Alex on the shore of Lake Tahoe on a beautiful spring day several years ago. And this is the sort of things you get to do when you learn to trade. So the long view here, the 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials become big spenders over the next 15 years, while 80 million baby boomers fade from the scene. We are at the beginning of an economic boom that'll last another decade in 2023. The last time we had a demographic push, this is how the stock market did. It went up 20 times in 18 years, from 600 to 12,000. Are you ready for a replay? If we get the same kind of performance, you can expect stocks to go up 20 times from the 2009 bottom in 18 years to take us up to 120,000 by 2030. And if you think we're crazy, we're already 3/4 of the way there. This is where we are now, if you superimpose one chart on top of the other, except this time it's different. We have the tech supercharger technology, hyper-accelerating across all fronts simultaneously, and the pandemic has greatly sped up the rate of change. Development of quantum computers means that computational ability is about to increase 1 trillion-fold at no cost. The world's major computational challenges will be solved. All major human diseases will be cured. Barbell stocks, I need to go back. Can't find it. Oops. Can't find the back. Oh, here we go. Back button. Sorry about this, folks. Barbell stocks dominate in this scenario, so the future looks great. To play the next 90,000 Dow points, sit with Mad Hedge Fund Trader and Global Trading Dispatch. Tap into a top-performing trade mentoring service. Follow Mad Hedge Fund Trader research and trade alerts, and you will rake in the profits. Let a jack of all trades steer you towards great profits. We trade single stocks, options, ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical trading month. We do about 200 trade alerts a year. 95% of them are profitable. As you can see, there's equity, fixed income, foreign exchange, and precious metals there. So it's just a matter of time before barbell stocks break out to new all-time high. Watch this space to melt up going to the end of 2023. Get ready to bank some profits with Global Dispatch Trading as your guide. So here's how our algorithm works. It predicted an imminent breakout in Tesla when it was back at 66. So we sent out a trade alert. It said, buy Tesla at 67 or best. And here you have 149 shares, which gives you a $10,000 weighting in the stock. What happened? We had a 63% move in Tesla in 20 days, up to 109. So we sent out another trading alert saying to take profits. And on this particular trade, we made $6,258 in 20 trading days. What do you do after that? We buy the dips in Tesla and we ride it all the way up to the old pre-split adjusted price of $4.45. So Mad Hedge 10 baggers, who doesn't like making 10x on their trades? Simply mouth-watering. So we recommended Zoom at $60 and it went up 10 times. Another one was Lam Research, recommended at $51 and it went up 10.6 times. NVIDIA, another one, recommended at $38, went up 16 times. Square, recommended at $10, up 25 times. Moderna, recommended at $15 and went up 40 times. And Tesla, our favorite stock, recommended at $235, went up 180 times. So with Mad Hedge Global Trading Dispatch Service, you get instant trade alerts sent out at market sweet spots, about 200 a year, and all the reasons to execute them. Live bi-weekly strategy webinars like this one with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars that then you can consume in a lifetime, and access to a 14-year database. This is a one-stop shop for individuals who want to understand what is happening with their retirement funds, for people who want to learn how to trade for a living, for smaller institutions and financial advisors who want to get in before the next market melts up. And this is me in Portofino, Italy in 2013. When you join Mad Hedge Fund Trader, you receive global market comments newsletters 5 days a week. You will also receive Mad Hedge Hot Tips, the 5 most important things that happened today. Now, for this service, I'm not going to charge you $100,000. That's what big hedge funds pay us for our service, and they're happy to do it because we make them millions of dollars. We're not going to charge you $10,000. That used to be our price for our concierge service. We're not going to charge you $3,000. That's the lowest price you will find on our website today. Here's the offer you can't refuse. 6 months for just $9.97. That's a 66% discount. So it's only through this webinar you can receive our service for $9.97 for 6 months, which is a great deal. It's a limited time offer, and we only take 25 new subscribers at a time. So it's first come, first served. Just click on the chat box on the right, and there will be a link to a dedicated sales page, which can only obtain through this webinar. Let me make the money for you to pay for your subscription. You make the trades. Just click on the link in the chat box on the right. Here's the offer you can't refuse. 6 months for just $9.97. Let me show you how to make the money to pay for your own subscription. Click on the link in the chat box on the right. And when you do register for our service, you will instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. So don't leave money on the table. Don't sit on the fence. 95% of these trade alerts make money. So this is the chart of the trade we're going to send out to you. Can you guess what stock it is? Do you think it's a buy or do you think it's a sell? Here's the offer you can't refuse. 6 months for just $9.97. Let me show you how to make the money to pay for your subscription. So let me check. Oh, by the way, that's myself and Alex in Paris at the Louvre. In 2013, we had a great time. He'd just come back from a French language camp where he learnt some French. So I'm going to check my emails and see if we've had any orders come in. I see Rodney from Australia, from Sydney, has taken the plunge to work with us. Thank you, Rodney. A warm welcome. I see Jay from St. Petersburg, Florida. Thank you, Jay. We'll work hard to make a lot of money for you. I see Cody from Wyoming. A warm welcome to you. Let me see. More orders are coming in now. It looks like we're going to hit our 25 fairly quickly. Okay, we have Eric from Flagstaff, Arizona has just come in. Thank you very much, Eric. We have Adam from Durham. Many thanks, Adam. Let me open up a few more here. We have Tracy from Grand Junction, Colorado, and Michael from Corpus Christi, Texas. Welcome to you both. Let's see, starting to come in now. We have Peter from Shreveport, LA has just come in. Thank you very much, Peter. Welcome. We have Jeff from Plattsburgh, New York. We have Judy from Memphis, Tennessee, and Seth from New York City. Welcome, Seth. And Ian from Cambridge, England. And also a note, if you don't have the trade alert already, please check in your junk folder. That's where brand new subscribers go to sometimes. Once you enable the address, then you'll have no problems in the future. I see my time is up soon. So what a wonderful summit. I certainly have a look if there are any questions here. Is there a 12-month option? Once you purchase, you will be grandfathered in at this price. So at the end of 6 months, you can renew for the same $9.97 or upgrade to our services like our technology letter or our biotech letter, or to our concierge service, which is now $12,000 a year. There is a waiting list for our concierge service. So we want to make sure you know what you're doing before you go to those higher levels. Here's another question. How do we know when to get out of a trade? We provide exit levels, so you don't need to be concerned with when to exit a trade. If the trade doesn't work out, we put out a stop loss alert, but that only happens about 5% of the time. And we tend to stop out very quickly. Usually when the loss is only about 1% of the portfolio, because it's, of course, much easier to dig yourself out of a small hole than a big one. There's more questions here about mindset. Marie is asking, what is the mindset you have when things don't go the way you expect them to? You must approach the markets unemotionally, because when you're emotional, you're going to stop out at the bottom, just when all the big traders will jump in. Mad Hedge has rigid stop loss rules. When they hit my stop loss, we are out and we go on to the next trade. And that's easy to do when you know the next trade, 95% of the time, will be profitable. Risk control is one of the most important parts of asset management. We have the risk controls of a major hedge fund. You want to hang on to it after you make it, of course. Let's see, anybody else has come in. See, oh, Douglas from Georgia. Hi, Douglas, thank you very much. How much is it after 6 months? Again, it's $9.97 for your lifetime. And a lot of people have actually done this. They've bought the subscription at $9.97 originally, and they just keep rolling over the $9.97 subscription year in, year out. We have some customers from 15 years ago. So I suggest you join our community and have fun while you learn, make money, and change your life. Thank you very much for listening.